Welcome to This Explainer. Today, we're pulling back the veil on the unseen, omnipotent engine that quietly drives the entire global economy. While the financial media constantly hypes up the stock market, there is a much larger, much quieter force actually pulling the strings. It's the fundamental mechanism where governments, municipalities, and mega corporations go to raise their capital. We're talking, of course, about the global bond market.
So let's just dive right into it. $140 trillion. This mind-boggling number is the estimated scale of the global bond market today. It's literally the true wizard behind the curtain of our economy. It acts as the ultimate pricing engine for money itself. It dictates the cost of borrowing across the entire globe, meaning it directly sets the rates for your mortgage, your auto loans, and even the national sovereign debt. It is absolutely the bedrock of global finance.
Now, there's a fascinating, almost funny contrast between stocks and bonds. We constantly hear about the flashy, story-driven stock market, right? The latest tech IPOs, the daily ticker shock on the news. But the global stock market, which sits at roughly $115 trillion, is vastly outsized by the cold, calculating bond market at well over $140 trillion. Why? Because bonds serve a crucial dual purpose. They allow issuers to access massive pools of capital without giving up equity or control, and they give investors a predictable yield and lower risk wealth preservation against those highly volatile equities.
Section 1. The History of Debt. From clay tablets to global yield curves.
To really grasp the magnitude of this $140 trillion wizard, we have to look at how it evolved. If you trace the physical evolution of debt, it's a wild journey. We start way back around 2000 BCE in ancient Mesopotamia, where the earliest recorded debt contracts were literally inscribed on clay tablets to track grain and livestock loans. Fast forward to the 1300s, and Renaissance city-states like Florence were inventing modern state bonds, known as the Monte, to fund their wars, paying citizens annual interest. Then, in the 1750s, the British war machine completely leveled up by issuing consols. These were bonds with absolutely no maturity date that just paid perpetual interest. This formal, highly liquid bond market allowed Britain to routinely outfund rival superpowers that had much larger populations. And that leads us straight into the 20th century, where the US issued Liberty bonds for World War I, introducing mass retail bond buying. After World War II, the US 10-year Treasury notes cemented its place as the global risk-free benchmark asset, the very foundation against which all global financial risk is measured today.
Section 2. The Golden Rule of Bonds. The inverse relationship.
Okay, now that we know its history, we really have to learn the core magic spell that makes this wizard operate. It's all about the teeter-totter mechanics of fixed income. The absolute golden rule here is this: price and yield move in exact opposite directions. Let's break that down, because it's crucial. When interest rates rise in the broader economy, existing fixed-rate bonds that pay a lower interest rate suddenly become way less attractive to investors. So to find a buyer, their market price literally has to fall. Conversely, when interest rates fall, those older bonds you hold that are locked in at higher rates suddenly become premium assets, so their market price shoots up. It is a perfect, continuous, inverse relationship.
To truly grasp your return in this seesawing market, you look at a metric called the yield to maturity, or YTM. This isn't just the sticker interest rate printed on the front of the bond. The YTM intricately calculates the predictable coupon payments you're going to receive along the way, alongside the gap between your purchase price and the bond's final face value when it matures. It's the definitive measure of a bond's total annual return if you hold it to the very end. Essentially, it's your actual bottom line.
Section 3. The New Macro Landscape. The Post-Rate Hiking Cycle. So, bringing this into the present day, let's look at the macroeconomic landscape following that massive global rate hiking cycle from 2022 to 2024. We are definitively in a higher-for-longer regime. After almost 15 years of near-zero or even negative interest rates post-2008, global benchmarks have structurally reset. The U.S. 10-year Treasury yield has been hanging out in the 4.0 to 4.5% range. For the first time in a generation, investors are actually being offered real income returns. But what's equally fascinating here is the total desynchronization of central banks. They are no longer moving in lockstep. While the European Central Bank and the Bank of England have had to pause or slow their rate cuts due to sticky inflation, the Bank of Japan has actually been incrementally hiking rates, completely abandoning decades of strict yield curve control. This is triggering some massive global capital reallocations. And consider the sheer, unprecedented supply pressures currently hitting the market. Global government bond issuance is shattering historical records.
soaring well past $11 trillion globally. Major economies are running persistent, enormous sovereign deficits right now. And because investors are being asked to absorb these historic volumes of government debt, well, they aren't doing it for free. They are forcing governments to pay a higher term premium, basically demanding higher long-term yields to act as a risk buffer against all this new supply flooding the market.
But here is a genuinely surprising twist in the data. You would naturally think that with benchmark interest rates this high, corporations would be buckling under the borrowing costs, right? Actually, no. Corporate credit spreads, which is the extra yield companies have to pay above government debt, remain historically tight. Despite the high rates, corporate balance sheets have shown just incredible resilience. This has driven robust, continuous demand for both high-yield and investment-grade corporate bonds. The private sector is weathering the storm remarkably well.
Section 4. The ultimate truth teller, the market judge.
We've seen its size, its history, and the current pressures it faces. But the bond market's most important role is as the ultimate judge in global economics. While equity markets are largely driven by growth narratives, hype, and sheer optimism, the bond market is cold, analytical, and heavily focused on risk. It is the ultimate truth teller. Throughout history, from the financial downfall of Napoleon to modern sovereign debt crises, when the bond market revolts and drives yields up uncontrollably, it does not matter how powerful you are. Politicians and central bankers are ultimately forced to yield to its economic discipline. It is the one market that absolutely cannot be spun with good PR. Which leaves us with a pretty critical thought to ponder. As governments globally continue to pile on unprecedented record-breaking debt in a high-rate environment, the pressure is steadily mounting. We really have to ask ourselves, when this $140 trillion wizard inevitably flexes its immense power again, who will be forced to pay the ultimate price? Thank you so much for joining me for this explainer, and definitely keep your eyes on those yields.